Hello, my name is Alan Fu, and today I'm going to talk about capital requirements of different types of oil company. Basically, how do people fund hydrocarbon exploration and development? Oil and gas is a very capital-intensive industry. Oil wells cost millions. Average oil well in the United States, looking at shale gas or shale oil, costs between $7 and $10 million. Some might be a little cheaper than that, but that's roughly the order of magnitude. That's fully completed. Deep water wells cost between $50 and $100 million. Seismic surveys cost millions, and complete projects such as offshore platforms, pipelines, etc., they will cost hundreds of millions to billions plus. People outside the oil and gas industry are quite amazed at the scale of these figures. The other thing to bear in mind is all of this capital expenditure is spent before any of the revenue from production is received. A lot of capital is spent up front before anything comes back. So, very high demands on capital. Let's talk a little bit about different types of oil company. So, at the very top you have the Western companies, the international oil companies, or the IOCs. You have the oil majors. These are the giants, the Shells, the Exxons, the BPs, Eni, Equinor, Total. These are large integrated companies that operate all over the world that have market capitalizations in the tens of billions, hundreds of billions plus. Then you have the large listed independents, both North American, such as Devon Energy or Pioneer, etc., or international, such as Tullow or London. They're listed on stock markets and they have market capitalizations in the billions to hundreds of millions. Then you have smaller listed independents. So these will be companies that will be startups that will be gaining revenue from stock markets. Generally, they tend to be listed on alternative investment markets, etc., when they're starting up. Then you have private companies. So these are IOCs which are not publicly listed. They might either be owned by wealthy individuals, wealthy families, or private equity. And then you have utilities and conglomerates. So these are companies that have many interests, but also have an oil and gas division. Traditionally, there used to be utilities, the Centricas, the Eons, Ruhrgas, RWE, but a lot of these utilities are now moving out of E&P, concentrating more on their core business. You'd also have companies such as BHP, which is a natural resources conglomerate that also has a very significant, quite successful oil and gas division. Then you have national oil companies. So this includes both home-focused, such as Saudi Aramco, and internationally focused, such as the Chinese companies ONGC, and the contractors and service companies that provide vital services to keep them all going. So who produces the most oil? It's split about 52 to the national oil companies to roughly 48 to IOCs plus the unaccounted fors. But you can see in green on the pie chart, these are the OPEC national oil companies. The reds are the Russian companies. The yellows are the Chinese companies. And these are other non-OPEC national oil companies. And the blues are the international oil companies, the majors, with roughly 13% of the pie. Then the listed smaller IOCs, very small non-North American IOCs, and then the unaccounted fors. So you can see here that it's split roughly 50-50, but the IOCs have by far the most oil reserves. This is looking at stages within the E&P life cycle, so different stages have different funding requirements. Most of your capital expenditure is spent here. So developing fields, that's where the real money goes, but also getting to that stage through exploration and appraisal. So let's look at what we're going to be looking at as the different types of funding. So you have exploration funding, which is finding new resources and replacing proved reserves. Then development project funding, which generally tends to be roughly 10 times or thereabouts your exploration funding. So that's turning those resources into reserves by developing the projects. How do people obtain funding? And how what is the competition for funding within these particular companies? So let's look at the majors first of all. These are big companies. They have exploration budgets of over $1 billion a year. So they spend over $1 billion a year looking to replace their reserves, which is a tough ask because if you're going to be producing 1 billion barrels of oil equivalent a year, to maintain your reserves, you need to turn resources into you need to add 1 billion barrels of reserves every year. Some of them manage it, some of them less successfully so. Most of that exploration funding is from free cash flow. These companies generate a lot of cash. In terms of developing projects, The smaller projects would be all done from free cash flow because they generate a lot of cash flow. Some of the very large projects may require bonds, loans, or project finance, but you're really talking about extremely large projects that have to do that. And they do raise bonds on the bond market fairly frequently to manage their cash flow. And where's the competition for the funding? Mainly from other internal investments. Downstream and increasingly, particularly for the European majors, on electricity and renewables. Plus, they've got to generate the dividends and the buybacks to give investor return. They generate a lot of dividends, which is a major part of the dividend total on listed stock markets, particularly FTSE 100. Shell and BP dividends produce a lot of the dividend share of that. And they have to produce that year on, year out. It's a tough ask. The large listed independents, now they typically have exploration budgets of $100 to $200 million a year. Most of the funding tends to be from cash flow, although they would occasionally seek farm-ins for funding. The development project funding, some of that may be done from free cash flow for mature companies, but they may also require bonds, loans, and project finance, a lot more of that than a major would, for example. And in terms of competition for funding, you've got mainly shareholder returns. Do you give money back to shareholders, dividends and buybacks? And also, where do you fund conventional versus unconventional projects? There's somebody like Hess, for example, that does both. There's a competition within Hess. What is likely to give you more returns, and how do you balance things out? For small listed independents, exploration budgets are typically quite a bit less because they're smaller companies. So $10 to $15 million a year, they may participate in 3 or 4 wells. Some may be so small and focused on a particular geographic area they may only drill 1 well a year. The exploration funding, some of that may be from free cash flow if they've got production. They may also try to farm out some of their exploration projects. So a larger company comes in, pays to promote, so effectively they would get much less expenditure for it. There's also loans, bonds, equity for the startups in order to try to get funding. When you're coming to development, particularly if you have very little in the way of cash flow, you would tend to go for loans, bonds, selling equity, farm-in or asset sales in order to try to keep that going. Some companies have a strategy of basically finding stuff and then selling it on once it's been found. And then they recycle the money into further exploration. Again, competition for the funding, unconventional projects or shareholder returns, dividends or buybacks. If you've had a major asset which you've sold, do you reinvest that in exploration, or do you just give that money back to the shareholders? The privately owned, not listed companies have a slightly different way of looking at things. Again, their exploration budgets are variable, could be 10 million, could be 100 million, etc. Depends on the size of the business. Some of the funding could be from free cash flow, somebody could be from farm-in, some could be external loans and bonds. Again, private equity houses may bring in more money. Development, again, loans, bonds, equity, farm-ins, asset sales, etc. And the competition for funding is also quite significant because you have, particularly in private equity, you have other private projects within the private equity portfolio which may give higher returns, returning the value to investors. And if you're in private equity, what's the exit strategy? Would you float it off on the stock market? Would you try to sell it as a concern to another company, either an IOC or an NOC? Again, looking to see where things would go. Utilities and conglomerates. Again, the budgets can be quite variable depending on how much they're into E&P. Used to be very fashionable about 5 to 10 years ago. Now it's declining because they're moving to other projects within the company. How does E&P stack up against other opportunities? How does it go in with the ESG agenda that they may have? Do they want to stay in the exploration game? Is this the right thing for you, particularly when you have quite a different risk balance to some of the other businesses? Exploration is risky. Only 25%, 30% of exploration wells actually work. So 70-75% don't. So that money that you've put in the gamble will be written off. The ones that work more than make up for the ones that don't, but are you comfortable dealing with risk? And some companies may not. Again, quite a lot of the funding would come from a parent company, and the parent company doesn't see effective returns, or the risk profile isn't right. They would move on to other things, which is to some extent quite a few of them are doing, particularly the European utilities. Now, in terms of the national oil companies, it's a lot more opaque. We don't know what exploration budgets of somebody like Saudi Aramco is because they don't tend to publish that, unlike the Western IOCs. Could be very variable. How is funding done? Some of it's from free cash flow, some of it's from government funds, but there's also carry by IOC partners. So in some production sharing contracts, and I've got a video on production sharing contracts within my channel, exploration may be done by an IOC that comes into the partnership. They would effectively pay for all the exploration as part of the deal. The development would be from free cash flow. Some of it would be from bonds and loans. There's also opportunities for discovered resource opportunities, which is when you have a project which has been found by the national oil company, but they don't wish to develop it for a variety of reasons, either costs or technical risk, and they'll bring in an international oil company to do some of the development. And the competition for the funding is a lot of these people are cash cows for the government. They're responsible for a large portion of government revenue, and government calls on government expenditure may well impact their own particular forward budgets. If you're looking at the away-focused national oil companies, people like the Chinese oil companies, Petronas, and also ONGC, their exploration budgets are again variable. We're talking hundreds of millions though, because they used to spend a lot on overseas exploration, a little bit less so now. Exploration funding could be government funds, loans from state banks, particularly at relatively soft interest rates, and from free cash flow from existing production. The development project funding would be, again, bonds, loans from state banks, government funds, and free cash flow. A mixture of all of the above depends very much on the company. And the competition of funding is from government spending priorities. Also home versus overseas projects, particularly if you're companies that have both home and overseas assets and home and overseas projects. Do you want to spend the money developing your own resources in your own country with less political risk, or do you want to go to another country where the potential for more political risk, but maybe potentially higher reward? Again, difficult question to answer, and they're all answering in slightly different ways. Another feature with capital requirements, which can be quite awkward, is mismatch within a joint venture. Now, a lot of oil and gas companies oil and gas projects are run as joint ventures between different companies. So, for example, let's say you have a project where Shell has 20%, Exxon has 20%, another company, let's say Tullow, has 10%, and then the national oil company has 50%. Now, obviously, the different companies would have their own different financial requirements, and there could be a situation where there's a mismatch in terms of how much people are willing to spend. And this can cause some issues within JVs, partners that may delay projects, but then partners may also sell out. Now, there's also an issue within a JV with a production sharing contract where the international oil companies may carry some of the costs of the national oil company through the exploration phase and maybe even through some of the development phase. They'll get it back through cost recovery, but again, it's a question of how our spending is aligned with the different business plans of the different companies. So, another thing I'll talk a little bit about is the threats to capital funding from oil and gas divestment. Now, obviously, it's becoming a bigger issue in the last year or two, and some Western financial institutions have decided to reduce funding for oil and gas projects due to green concerns. There's also been divestment in oil shares for some institutions. So let's say if Harvard or Cambridge University decide to sell their Exxon stock, well, somebody else will just buy it off them, so Exxon isn't really that affected by it. But if a Western bank decides not to loan money to an oil company for a project, that tends to be a little bit harder because the pool of money that's available gets less. The biggest impact's actually on the smaller listed Western oil companies, because they're the ones that need more external capital. Also, there's potential significant impact on contractors because they need a lot of capital to build the rigs, build the seismic boats to enable the oil companies to do that. The least impact tends to be national oil companies because they tend to be internally self-funded, or Asian companies that tend to get capital from their own local banks. So this gives you an overview of a very capital-intensive industry. So this is just a summary table that tells you what we've done so far. So capital-intensive, different companies affected in different ways. Thank you very much.